So our first company was Interactive Technologies, and we founded that, myself and Bob Shaw were the co-founders of that business. And we started off building travel technology for the Australasian market, and by chance met up with Andrew Bagnall, and at that time he set a challenge for us to look whether we could actually globalize our technology through his group. And in around 6 weeks, we built the first prototype of that technology and launched that and demonstrated that to him. And it became what they deemed as the biggest virus to go through the travel industry, in that we sold it to around 80% of the travel management companies across both Australia and New Zealand. And at that time, Andrew Bagnall invested into us. So our first investment round was with somebody within our trade industry. He invested, it was quite a small amount back then, but was quite big for us as a startup. And the leverage that we then gained from that led us through to being included in the public float of the Gulliver's Travel Group. That was in 2004, and in 2007, when just before the GFC was hitting, we set up Serco. Serco was basically founded by myself and Bob and 26 of the core team that we had with us in the first company. And Serco was set up with some very strong mission, and we wanted to really control dates and time really importantly with what we were trying to do, so the milestones were absolutely key. One of the things that we set about was that we wanted to either look at a trade sale or an exit strategy within 7 years of the business, and we formulated a very controlled plan about how to actually get there. In fact, we listed our business on the same day that we founded our company 7 years later. That's how focused we are on dates. The other thing that we're really focused on is around cash management, and we do these plans out 2 years, and we always imagine a worst case scenario, and we sort of run these models through, and if any time that cash could drop down below a certain level, we go and raise money. Now it's quite different being on the public market. On the public markets, you can raise money quite quickly as long as the story and the models actually align. In fact, you can complete the task in around 2 to 3 weeks. You don't actually have to go through the same level of due diligence, but you do have to go through what's called a due diligence committee or a DDC. And this process validates all of the market statements that you're actually making. So today we've raised around 90 million out of the market to fund Serco's journey. So we've listed on both the New Zealand stock market and of course the ASX market as well. Our first raise was 22 million. It took us about 6 months to get onto the public market. A lot of people say it's probably the one thing they wouldn't do is actually list their business. Having gone through this process twice, it's both daunting and exciting to be on the public market because you get visibility. But the key part is having a story, a revenue model and a growth model that actually can be articulated to the market really, really well. So in 2014, we listed on the NZX, raised 22 million. That process took 6 months. It involved around 2 million of cost, and it involved accountants, lawyers, financial advisors, media, and everything through to the whole listing process. Once we'd done that, around 2 years later, we then raised another 8 million to build a new product. We actually completed that process in just over 3 weeks. So we were able to go through a lot tighter process and complete that very, very quickly. We then last year in September raised another 15 million and were able to execute that again within about a 4-week time frame from start to finish. And then this year we've just completed a $45 million raise That was a little bit more complex, and with this one we actually had the largest player in the world in our space, being Booking.com, invest in alongside us. And the complexity around having a cornerstone come in at the same time adds a lot of complexity around the due diligence process, around a lot of the market regulations, and around how your business is going to be perceived in the future. So a lot of these things had to be considered through that overall process of really making sure the percentage that they were going to hold, the commercial agreements and everything were going to be based on what our overall vision or mission for Serco was. It is, so being listed is, a lot of people, I think 2014 was the year that we listed. There was 14 companies, and of that a lot of them failed and have had quite a negative downturn in their share price since listing. The key thing that we sort of outlined is the one thing to remember is your strategy and your mission has to be very clear and able to be communicated. If you're not communicating that to your investors or your potential shareholders, then no one understands the story for you to be able to buy or for them to buy shares in you. But being listed has that visibility to be the same or better than your competition, and that being on the public markets gives you public market credibility. You're already compliant based on the regulation, so it puts you at a different level to other businesses and other peers in the same group. The other side of it is that as a public company, you have to, the one thing I probably teach people is the line that cash is more important than your mother. And a lot of people find that quite compelling or perplexing. And it really is that if you think about it, the best businesses fail through poor cash management. And one of the things to remember is that doing these models out 2 years gives you that absolute insight into how you can actually recover, make sure you have this cash in the bank to get through those points when there could be a downturn. So for us, looking where we are today, and we raised 45 million, we had our model told us that if there was a GFC in the next 2 years, we could burn 35 million of cash. And so we've raised 45 million, plus the money that we already had in the bank, meant that we were well protected and could execute our strategy, which was the most important thing. So you formulating the right board is absolutely key to driving your vision. So if you have a board member that is not aligned as a founder to the overall strategy of your company, it's going to make it really complex to execute. So that alignment of finding experts in the business where you have weaknesses can be absolutely key. So in our case, we had Simon Botherway, who had established and chaired the FMA. So he was the highest person in governance. So being an entrepreneur, you're sitting over here, and governance is over to the left. So running really hard over here, wanting to burn cash, and having the model of governance that drives that back was absolutely key from a board perspective. Then we had Claudia Batten, who thinks like us, but was a marketing expert. And we weren't marketing experts, we were tech experts. So having that part of our board gave us that absolute depth as well. So key parts of having this overall board composition attracts the investment. So having Simon Botherway, who was actually an investor, an analyst himself, has given credibility across New Zealand and Australia in the business and what we've actually been able to achieve. And he attracts natural funds coming into there. So sometimes establishing the right board can actually make raising capital a lot easier. So that's one of the key points in this, is the actual board composition and what type of capital you're going to be looking at as well. The other side of it is when you're looking at that, one of the key things that we were taught is to have a small piece of a big pie is actually pretty cool. So we started off with 100% ownership of the business, and we in fact gave 40% away to our staff. So those 26 staff members that came on board, we actually gave them 40% into a convertible note scheme that on an IPO or a major transaction that would turn into valid shares. So we had team members that were owners working at the same level as ourselves. So they were working just as hard for the business as well as ourselves in the business. And so that gave quite a strong core team. And as new people came on board, they also got allocated shares inside the business. And having that model as a startup was absolutely essential. We weren't paying the highest salaries, we were paying sort of mid-market, but that share incentive enabled them to have some ownership into their future. And if they left within the 2 years, they would actually lose that. So the carrot was that they needed to stay for that major transaction to get that. And so some of those foundational things are absolutely key to how you want to build it. It's very common in America, but it's not actually that common in New Zealand to actually have those types of structures. As you go through, so those team members now if they believe in the vision, they don't sell, and they create a stable base which keeps the liquidity of the company very small. So as a public company, when you go through this first phase, you've got to be able to keep the stock moving forward. One of that is the founders telling the story, but it also means you don't want everybody dumping their shares at the same time. So if people believe in the vision, they hold on to their shares because they're executing together. So strategy alignment is key inside any business. So it's making sure from the receptionist to right the way through the organisation that everybody can articulate the strategy, and making sure that the cultural aspects of surveys and everything are done until such time as every single person rates a strategy, that they understand it and they can articulate that 10 out of 10. And it's that alignment that delivers everything to your investors. If everybody's going on the same journey together, then that's absolutely key to getting the successful outcome. And those are some of the things that we learned when our stock crashed to 30 cents. So when we were sitting there, and after a year or almost 2 years of being listed, our stock dropped, I think actually a low of actually 25 cents. And that was very hard for your team when your stock goes from a high to an absolute low. To do that is through teaching everybody about execution. So we worked inside the parameters of a box, and we only executed the points that were needed for the market to make sure that we could actually come out of that cycle. We produced no negative numbers, and the team then refocused on the strategy at hand, and through pure execution delivered the outcome that's now taken our stock to being in the top 10 each year, and in 2017 was the number one stock on the New Zealand Stock Exchange. So execution is always going to be key as you're going through raising money and making sure the story you've told the market is the story that you actually execute on. Otherwise, it'll be almost impossible to raise that second amount of money.